imagine all of you are here because of this just incendiary, catchy title as presentations go, but really appreciate you coming here. Today, my name is Joseph Behrens, and I am a training specialist at Chainalysis. Prior to working at Chainalysis, I was a compliance investigator at at Gemini for about 3.5 years, and then prior to that was a thoroughly unemployed law student at our mutual alma mater. And I will let Alma introduce herself.
So hi everyone, I'm Alma Angotti. I'm a partner at Guidehouse, partner in financial services, and we do a lot of work with our friends at Chainalysis, a lot of work with digital assets companies, and so my background is SEC compliance, FinCEN compliance, and FINRA compliance, enforcement, so, and I've been a consultant for about 10 years.
So we have a little bit of crypto expertise and then alphabet soup. Whole resume of DC agencies. So great. Okay, so the first thing we wanted to really establish is some actual principles, right? So this word compliance is thrown around a whole bunch, often to people that are just joining the industry, but what does it mean to comply and what exactly are they complying with? So, we have the structure of anti-money laundering recommending bodies, right? When AML comes into being in the early 90s, we first have the FATF 40 recommendations issued, and there have been many sort of different specializations and different groupings of international, regulators that are putting a lot of thought into this. And as far as international law, which is in general something of a minefield, there is an unusual amount of parity in this particular area, recognizing that our financial system is completely global, it's completely interlocking, and therefore we need to have the same general structure even if the exact legislation is not one-to-one. So that is where we sort of get this, and then after the recommender level, we have different countries and the way they choose to adapt those recommendations or adopt those recommendations. So at this point, we then have the statute level. In the United States, we're dealing with the Bank Secrecy Act, but imagine an equivalent statute in every other jurisdiction that is endeavoring to be compliant and set up a system that is compliant. And then finally, we've got, who needs to comply? In general, in the case of cryptocurrency businesses, we call these virtual asset service providers, or VASPs, which I'm going to try not to say too much because I have just a slight lisp on my S's, and that word in particular is just, it's terribly annoying. So I might just call them money service businesses for now, which is just slightly better on that front. So we have virtual asset service providers, and these are businesses that exchange, transfer, custody virtual assets. From a practical standpoint, you can pretty much apply this term to every single cryptocurrency business, sans miners. Though, as Clark will tell you, maybe miners someday. We're just not sure. But for now, not miners. So what are they complying with then? What are these statutes endeavoring to do? And as far as the goals of anti-money laundering, really we're recognizing that all criminal activity, or the vast majority of it outside of crimes of passion, are motivated by profit, right? Now, all kinds of ancillary criminal acts happen, but at the end of the day, the ones that are leading these criminal enterprises are endeavoring to make a buck illegally. And at that point, they need to do something with that money to realize the value of the criminal activity, right? So they're gonna need to launder it. So working backwards from this idea, criminals do criminal acts and then they are looking to generate profit from these things. If we follow the money backwards, we can identify the criminals, we can prosecute criminals, and then there is this idea in the law of deterrence. So maybe knowing that some criminal has gotten caught before, we will prevent that sort of criminal act from occurring again. But whether this is just a theory or an idea, we can definitely deter future crime to some extent, and certainly prevent them from realizing profit, in these specific instances.
There, we could see that when I was at Treasury, and Clark, I'm sure you've seen this too, you can see shifting patterns laundering money based on what the law enforcement is focusing on, what the regulations are saying. So you can, for example, there were some new regulations in Mexico on cash deposit, on new regulations on money transmitters in Queens, and we saw an increase in cash just driven down I-95 and deposited somewhere else. So you can sometimes see it.
At the very least, the law can force criminals to be creative.
Yes,
right?
it costs them a little more money.
Yes, for sure. So as far as the goals and process, we have at the sort of bottom rung financial agencies that are tasked with complying with these laws that are about detecting illicit dollars. We have a large bureaucracy in the United States, but there is simply insufficient resources for them to do all of this directly, nor are they privy to the information that they need to have on hand in order to detect illicit financial activity. So the onus on detecting that is then placed on virtual asset service providers, money service businesses, really any financial industry actor. From there, recognizing specific suspicious typologies or using something like Chainalysis, we are then required to file suspicious activity reports or suspicious transaction reports. This creates a trickle upward of information, and then those are filed with our financial intelligence units. In turn, different government agencies, and this is not always a bifurcated role, right? So sometimes there is something like the NCA in the UK, which is just consolidated. Many different functions live in that agency, but the general structure is we are reporting suspicious transaction information upward to a financial intelligence unit, which is then going to organize that information for law enforcement agencies. They, in turn, are going to read these SARs, and if they are worth investigating, they will then send this to prosecutors, and ultimately, we are looking to catch criminals at this point, right? So upward flow of information from financial institutions through financial intelligence units, and then finally to government agencies here. So who has to comply? We said virtual asset service providers, but what are they complying with and where? And one of the factors that is determining the exact statute that they are modeling their program to, or at least like modeling one office of their program, or maybe one segment of their customer base, that is going to depend on the jurisdiction that has licensed them, right? So we might treat our customers in the UK or in Brazil differently than we would treat our customers in the United States. That can extend from everything as far as like what we're reporting to how much know your customer information we're collecting, exactly what we're required to obtain. So that's going to vary, right? And the agencies that you obtain a license from are then going to be the ones that will come in and examine you. They will examine your compliance program looking for some specific things. Many of the things that they're gonna look for are, again, consistent across different jurisdictions, but sometimes it will be specific to the license that you were granted and the authority that that body has. So to make this a little bit more concrete, before the OCC started issuing national charters to cryptocurrency businesses, every crypto business is applying to different states in a piecemeal fashion. That means you are seeking 50 different licenses from 50 different regulators that might, have inconsistencies between them. Now, a good number of states recognizing the burden of this, they will coordinate together and kind of conduct examinations at the same time. So you might get 5 states all at once that generally have the same framework, but this is not always going to be true. So we have our national agencies and then our localities that we are seeking licenses from because we want to have customers there. So those are the various potential people that could then come in, conduct examinations, and look for really systemic weaknesses in your compliance program. We also, within this examination structure, we have the need, and this goes in your general government examination of some kind, to conduct both internal examinations and then also seek entities like Guidehouse for audits, right? External private audits to, again, detect any systemic weaknesses in your compliance program and address them before they result in a systemic problem.
Thank you, Joe.
Absolutely.
So Joe talked a lot about the statutory framework. So what does the Bank Secrecy Act actually require? It requires all covered financial institutions, including digital assets companies in many cases, to have a compliance program to prevent, detect, and report potential criminal activity coming through the firm. And it is a odd combination of a few very specific requirements and a lot of risk-based compliance principles that I used. When I was a regulator, I would tell the institutions, the good news is you get to design your program any way you want. The bad news is I will only tell you if you've screwed it up. I can't tell you beforehand if it was right. So
aggressive defense, right?
Well, yeah. So how does it work? So the underpinning of any risk-based program is the bottom there, the foundation, the enterprise risk assessment. You're supposed to do a very formal assessment of the risk of your customers, products and services, and geographies that you do business in, right? And then the top is one of the most, that is where I see the most problems in clients, and that is the management and board oversight. Compliance, management of the risk, is a business responsibility. Compliance just helps them. So you've got to have real board and senior management participation in the risk management. They need to set a risk appetite. How many risky customers are we going to be comfortable with? What are the outlines that we want? And for them to understand what's happening day to day. So, and what's happening day to day are something that in the US we call the 5 pillars of the Bank Secrecy Act and compliance. Written policies, procedures, and internal controls, a customer due diligence program, the designation of a chief compliance officer. When they passed this statute, they wanted to make sure that there couldn't be finger pointing at financial institutions, that there was somebody with a target on their back that had to be responsible. Ongoing training, and we'll talk a little bit about these in detail later. And then as Joe said, an independent assessment every year of the firm's design and implementation of their program. So there we go. So there are some things that we see, especially in fintech companies and startups and institutions and cryptos, that are a little bit not unique, but we're seeing them commonly because of the nature of the institutions and how fast they're growing. So the first concept of a written program of policies, procedures, and internal controls, when you have businesses that are growing very quickly, sometimes the written documentation of everything they're doing lags behind what they're actually doing. And so they're in effect not getting credit for the things they're doing. It's also hard to have consistency of application. It's hard to audit. It's hard to have compliance testing if you don't have good policies and procedures. And so you have to make sure that somebody is paying attention to making those documents living documents that change with the business. Also, as you know, in the crypto space, it's all about frictionless engagement with your app, with your business. That can often kind of collide with the requirements for customer due diligence and KYC. And I sometimes have clients call me and say, I looked up this app and they're not asking for what you're saying we have to ask people for. And I'm like, just wait till they get an enforcement action. I don't know what to tell you, right? Or sometimes I'll get on their website and it's like, I don't know what you're talking about. It says right here that you're asking for all of this. But anyway, that can be the tension, especially when you're dealing with institutional clients who sometimes can be higher risk and you might need to get more information. So, that's that. Let's see.
Before we leave that, I'm just curious, how many of you have an account at an exchange? Show of hands?
I'd be surprised if, yeah.
Yeah. And for how many of you that have an account in an exchange, did it take longer than a day to verify that account and your KYC information? Just yeah, we've got some takers. So it takes a while.
It can, yeah. And it's very frustrating for business people, and sometimes it's frustrating for customers. Some of that goes back to what I said about businesses growing very fast. Their onboarding technology or their onboarding team is not quite able to keep up with the volume. The chief compliance officer, one of the important things that the regulators will look at is not only the qualifications of the person, but do they have the resources, human resources and technology resources they need to do their job, right? Now, one of the things that people get very nervous about is there is personal liability if you don't do your job. But if you look at the cases that have been brought in this area, they're pretty significant systemic breakdowns and a failure to perform your responsibilities. They're not bringing a personal action against somebody because they didn't have 2 more analysts that they asked for, 3 months ago. So not to really worry about it, but it is important to know, which is why we always recommend you need compliance people to have direct access to the board, and the board needs to ask those questions. Do you have what you need? If not, why not? And not that you are going to get everything you ask for just because, unless you're in the middle of an enforcement action, then you probably will. But because you should have to explain it. And if you can explain it and make your case, they should give you those resources. Let's see. Ongoing training. This is another one, oddly, where we see lots of deficiencies. Everybody does the yearly basic training for everyone, but we see 2 big issues. The failure for people, for your team members with specific AML responsibilities to get that targeted training that they need to really do their jobs well. Sometimes people will say, oh, well, we're doing it, kind of sitting with somebody who knows how to do it, and that's all fine, but you need to have some documented, more formal training. The other problem is senior management and the board. Again, they own the risk. So you have to tell them what the risk is, how you're managing it, and you have to tell them what's happening in the regulatory space so that next year, when you come to them and say, I need more resources because DFS just said we have to have blockchain tracing, they will have that line of sight into how the regulations are changing that affects their risk management and their programs.
So I think what you're saying is hire us and hire me in particular.
Yeah, I mean, we're a good team. Yeah, go ahead. You too. All right. And look, feel free to ask questions as we go along. We're happy to take them. Okay, so here's another area that we often see. Did I not? Wait. There we go. Compliance testing.
One back.
I did too many.
We're good. Yeah.
You'd think, being sort of the technology person and fintech person, I would know how to do PowerPoint.
All good.
So as we said earlier, there is a requirement that you have an independent party assess the program every year. And that can be your own internal audit people. It can be an outside party. It just has to be somebody independent from the compliance function. And one of the biggest problems that we see is that sometimes that independent assessor will look at the written documentation and not do any compliance testing, not testing the transactions to see that somebody's actually doing those things. We had, this was a million years ago, and this was a bank, but we had found through some drug task force that this bank was laundering money for everyone. They all noticed in their team meeting that they were all using the same bank. And they had just gotten a perfect exam from the Fed. Why? And this is in the public documents. I'm not telling tales out of school. Because the Fed just looked at the documents and nobody was doing it. Nobody at the bank was actually doing it. So you have to, the independent assessor has to look to see if that's actually implemented. The other issue is, it is good practice, it's not technically required, but in a risk-based program you should do it, to have compliance testing, QA and QC of the program before that yearly assessment, because you don't want to wait a year if half of your customers aren't being sanction screened because there's a glitch in the technology or something. And so you want to have two things. You want to have QC, which is, are the people doing what the procedures say? Are your transaction monitoring analysts using the right protocols? But you also want to make sure those protocols are the right ones to manage the risk. So it's kind of two elements that sometimes get conflated. So that's, again, another one that sometimes we see, especially in a very fast-growing program. It gets kind of short shrift. And so there can be big problems, big workarounds that nobody knows about. And sometimes they're effective and sometimes they're not. So.
The other thing on the testing front that has fundamentally changed, and that like really is kind of different with cryptocurrency, is that a tool like KYT, many of you will be users of KYT. Now, on the industry side, that is something that we create rules in. We then find specific risky user accounts. We make that alert level decision. It might get escalated all the way up a process. But the other side of that is that when you are the subject of an examination, generally they are requesting somewhere between like a year and 3 years worth of data. And the way that they can perceive that cryptocurrency data is also something that can be incorporated into KYT. So instead of necessarily needing to weed through a ton of detailed documentation and read it all, maybe looking for somebody that didn't respond to a source of funds request or their answer was insufficient, you can take a big data approach to zero in on the riskiest users and the riskiest transactions that were not acted upon.
I should have probably asked this at the beginning, Joe. How many people here are in a compliance function? See, a lot of it. I've been telling you guys stuff you already know. Are there any questions about? Yeah. No.
That ex post facto information about past events. Internal audit or compliance testing is coming in after the fact. What is your point of view on sort of, if an event gets recharacterized, is there an obligation then to periodically do look-backs in the event there is a recharacterization of events?
So I think you need to have policies that say when you're going to do that, right? You don't have to do it every single time, but it's just like if you get a law enforcement subpoena, it doesn't mean you file a SAR, but most institutions will go back and look at that account in light of that subpoena and say, wait a minute, maybe this looked okay at the time, but now I've got other information. So I think it's the same thing. You might, a sanctions hit, for example, you probably want to revisit because that's strict liability and you can't do anything about it. Maybe something that's suddenly associated with child exploitation or a fraud, maybe you want to look at it. Something that just hits because it's a peer-to-peer network transaction now, or something that's not as risky in your risk appetite, then maybe you don't have to. But I think it's more important, the regulators will be looking at, do you have a process? Do you have a system? Rather than really second-guessing too many of those choices that you made, as long as you have a process and they're documented. And if you can tie it back to your risk assessment, that's even better.
Yeah, and I mean, as it plays out in KYT as well, I dealt with this, in a very unpleasant 3-week stretch when Hydra Market was originally attributed as it was Alpha Bay, when that was attributed as a darknet market, right? And suddenly, so many, like thousands of transactions that appeared completely innocuous are now looking very risky, and then also like as part of our alert decision framework or compliance policy somewhere in between, we would only tolerate so much darknet market activity, and then suddenly hundreds of users are above that threshold, which was predetermined. And so in the name of abiding by a written down policy, we're suddenly filing a whole bunch of SARs, and then in turn, when the regulator's coming around, it's like, okay, well, it was 5 SARs and then 10 SARs a month and then 30 SARs a month, and suddenly there's 200. What the heck happened, and is there a deficiency in your program? So that is because old information was completely recharacterized, which there is always the potential for using a product like KYT. And in that situation, I think it's very important to take like an education-first approach, right? So if you need to go the length of getting an outside legal opinion, then that is always an option to consider where it is particularly incendiary and risky looking. But just another thing you can do is write up exactly what happened in a centralized way and then have it available for reference when suddenly you're looking at like ugly metrics, which are in reality just event-based.
Would there be, though, an expectation, and maybe in this case it is just because it was such a significant event, but to actually go back to previously closed alerts, say a year ago, that at the time, given the information, were benign, but now, because of this new information, that alert may potentially be sufficient.
I think in extreme case, in significant cases, you probably want to do that. Okay. Like, for example, like going back to traditional finance, right? After Panama Papers came out, we spent a lot of time combing through voluminous KYC files that seemed fine when the bank opened the account, right? So again, if you kind of know what limits you're comfortable with going back and which ones you're not going to catch everything. Really, nobody expects you to catch everything. It seems like they do, but
So you think something in the policy that talks about where there are these like material events, I don't know what you call them, in those cases you may want to take a retrospective look at some, on a sample basis or whatever.
Right.
To determine if you have any exposure.
Yeah, and I mean, we're really seeing this with two things in combination, right? The sanctioning of entities by OFAC, so not just individuals and the cryptocurrency addresses they control, but whole entities. And it's not just an identification, it's a recharacterization from one thing that looked one way in our product to now looking quite different and angrier and redder, right? And in that scenario, there is also indirect exposure, right? Which is not something that exists in traditional finance. You are just dealing with two direct counterparties instead of being able to trace out the entire life cycle and journey of a little piece of Bitcoin. So like that is another thing that I would say explanation first and on hand, but also, make a risk-based decision, right? Like make a threshold-based decision. And if something, is recharacterized and it looks different now that the nature of the entity has changed, then, have a threshold where you're inspecting.
Because it will give you valuable information about the risk of your customers. If suddenly more customers than you understood are interacting with a market that's now been denoted as sanctioned or something, you want to know that, right? So think about what is it that you want to know, and then it doesn't have to be everything, and it can be a big pain. But if you think about it beforehand, and like Joe said, even doing a sample and then being able to justify, well, we sampled 10%, we weren't seeing anything new. Then that's defensible too. The regulators are really not that unreasonable. I mean, sometimes they seem like they are, but they really are not. But this is another thing I used to tell people. If you've screwed something up and I didn't catch you, I'm in as much trouble as you are, right? Remember the HSBC money laundering case when Congress called the OCC a lapdog, not a watchdog? Like, nobody wants to be sitting there hearing that. So,
Riggs, too.
Yeah, Riggs. I did Riggs, but I was at FinCEN. We weren't in trouble because we did it with the Justice Department. No, we did it, but the OCC didn't want to, right? I'm glad Dan Stepano's not here. But anyway, so.
Another question?
I have a question. I totally get the regulator side. I dealt with them when I was at Bank of America.
Oh, yeah, well. I worked with the Fox at FinCEN too, yeah.
I was in that. I ran compliance testing automation.
Okay, so you know.
I'm geeking all this out. So quick question. How much of this do you think is going to get automated, and how's that going to show up in like transaction costing? Because this is like a cost to a transaction, right? So how do you guys think through that?
As far as the automation, like my instinct is that,
Tech is cheaper than people.
Yeah, but like also as a level 1 analyst, you feel like a cog in a machine plenty of the time, but then there's always a moment where there is language like risk-based approach that kicks it into an entirely subjective and human instinct realm. So there's always going to be that layer that is kind of impossible to automate because it's a totality of the circumstances analysis that's not like hard and numerical, instead is like taking in a lot of factors, synthesizing them, and then reporting them in a qualitative way.
Yeah.
So I had one client that instituted an AI bot for their EDD, and it took 45 minutes out of an hour that their analysts were using to collect the documents to do the analysis. And what the compliance officer told me is, we found out we had a lot of people who liked collecting documents and didn't so much like the analysis. So you may need different people.
Yeah.
Joe, to your point, but you'll always need people. But you may need different people. So yes.
Joe,
Hey, what's up, Joseph?
so are we doing enough to address the human side of the equation, right? There's great technology, Chainalysis, data coming out, people looking at it, people interacting with it, but are we doing enough on the compliance side to address the humans that have to take that, report on it, do something with it, from a training perspective? And if not more, what could we do?
So that's a great question. You can never have too much training. And so besides the formal training and allowing people to go to ACAMS chapter meetings and things like that.
Yes.
Or that, yes. One of the things that's good to do, I think, and we do this at Guidehouse, is if somebody's got an interesting project, if somebody has done research for something for a client, we try every month to have like an hour at lunchtime webinar where they share that, and it lets them know the other cool, like the blockchain trainings are always way sold out because they're cool and they're different, right? But it helps people, it helps keep top of mind. So if you had a really interesting case that you filed a SAR on and it was a different set of red flags that you hadn't seen before, you might do a little presentation on that without the client's name perhaps, just to keep people thinking and not getting just rote in their investigations.
That's part of the point, too. Even going to the soft skills like communication.
Yes.
And things of that nature, they aren't necessarily trained in that. They're assumed to know that, right, coming into roles of manager, director, et cetera. And I see that potentially as a gap in the soft skills, the human side of things.
Yeah, we haven't done it in a while because we're all remote, but interview training, right? How do you talk to a client when we're doing a gap analysis and we've looked at the documents and we want to talk and see if you're really doing it this way? How do you ask crisp, open-ended questions and then just listen? So many people write these really detailed outlines and, so just little things like that can be really helpful.
Thank you.
Yeah.
Beneficial ownership in different jurisdictions. That's the big problem, I will say, biggest problem, but what do you think what we can do better in doing KYC and finding beneficial ownership? For example, in Africa, in Asia.
Boy, if you could answer that problem, you could solve for that, that's a really hard, or Delaware, if we could solve Delaware, right? We'd all be better off.
Yeah, I mean, that brings us to some of the questions that I prepared, and just, in general, information sharing and the mechanisms for doing that are pretty inefficient and kind of like inadequate to, for instance, like a company like Coinbase that operates, cross-jurisdictionally. That is one company. It is incorporated in the United States, and so you can kind of frame things that way. But given the fact that cryptocurrency can travel around the globe at a minimum of 10 minutes on average, and that's if you're just using slow Bitcoin, like what would you do, and like what would you like to see on both, let's say, like between the private sector and government, and then between governments internationally, as far as information sharing?
Yeah, so that's really key because, as you said, we've got a global economy and still local jurisdiction. And the public-private partnerships, the true, like Gimlet in the UK, I think are very helpful. We haven't really established that same kind of partnership because we've got a huge financial sector with lots of little institutions. FinCEN's working on some of those to because we give, the financial institutions give a lot of information to law enforcement and they don't get as much back as they really need to do their job. And so FinCEN is trying and was mandated in the Anti-Money Laundering Act of 2020 to help facilitate that. But they have 300 people and a bunch of regs to write and a lot to do, so I don't know how long it's going to take for them to get to that. But that would be really helpful. Trends and patterns in fraud, what are we seeing? So that you can look for that. You may need to change your transaction monitoring or do a training on, this is a new kind of romance scam we're seeing or a new kind of elder fraud we're seeing. So just more information back. And for those of you who are regulated financial institutions, to make good use of 314B, which is very unique to the US, which allows financial institutions to share information with each other about potentially suspicious activity. You don't have to participate, but it's really, I think, have found it useful. Now, a lot of banks won't share information with crypto companies, but I had one client who had to ask a big global bank, and they actually gave us a lot of good information that we needed. We were taking an account from them, and the client was taking account for them, was worried about it. So those are some tools. They're not as good as we'd like them to be, obviously, but I think everybody's focusing on this, and it should help over the long term, I think.
And what do you think about between governments? Because I totally agree with you. There's this element of I spent a week compiling information and synthesizing it for some regulator, and then 3 years later I see a DOJ press release and it's you didn't even tell me.
Well, and again, FinCEN's trying to focus on that.
But between the United States and the UK?
Yeah, I mean, you see a lot of cooperation because they say it now in the press releases. You see it in the corruption space, you see it in the crypto space, because it has to. Because again, these crimes don't have borders. There are local privacy issues, though. And there are countries where we're not sure that those prosecutions are not politically motivated. So it's not as easy as to say, well, we should just all share. Now, there's a lot that goes on behind the scenes with Egmont Group. Those are the organization of FIUs for countries. But there are always going to be some local issues that are going to have to take precedence. Now, there's one, for any lawyers out there, there's one provision of the Anti-Money Laundering Act of 2020. In the old days, if you had a correspondent account at a U.S. bank and you were a foreign bank, the U.S. government could subpoena any records related to that correspondent account. Now, they have expanded that rule, and it's in place now, so that if you have a correspondent account in the U.S. government can subpoena your records anywhere in the world. Doesn't have to be related to your U.S. transactions. That is a significant expansion of jurisdiction, probably related to some problems they had getting documents from China. But the real kicker is if you can't use your local privacy laws as a defense, and if you don't give them the records, they can close your correspondent account in 10 days, which could throw countries into complete disarray if they suddenly get their access to dollar clearing. So there are lots of different ways that the governments are responding to that. Some of them are pretty dramatic. Some of them are just, FinCEN is also going to have more people at embassies to kind of work on these issues with foreign governments. So lots of different things in process. We'll see how good they are when they get done.
Yeah, we will. We surely will. So if you could explain one aspect of cryptocurrency, and it's hard to choose one because some of these are just infinite rabbit holes you can go down as far as how complex something is technically. But if you could just pick one area of cryptocurrency as a technology to explain to a regulator and have them immediately understand it, what would that be? And then conversely, if you could explain one thing to compliance personnel at cryptocurrency businesses about regulators, what would that be?
So the first thing is traceability, not because we're here, at Chainalysis conference, but traceability, I don't think they understand the powerful mitigant that traceability can be, right? It's like I always, when I have my traditional bank clients struggling with this, I'd say, pretend there's a GPS sticker on every $20 bill in your bank, right? So you can see exactly where it's gone. So that I don't, and I was talking to a very large global bank last week, and the compliance officer said, well, but doesn't the tracing get messed up over time, and can you always see it? And I said, well, if it gets messed up, it's deliberate, and we can see that it has been, right? So, but typically you can see the whole ledger. The thing to tell when you're talking to regulators is they may not understand. So just explain it. If you have pictures, explain that. Because again, they have a responsibility not to let you guys do something that, you know, you'll hear, I think, in another panel, the 3 things that the US government is worried about. Consumer protection, right? Who are you selling this stuff to? What do they know about it? Do they understand the risk? Financial crime, and the health of the global financial system. So if you can explain to them how your product does not interfere with any of those things, they want to believe you, right? They don't want to be the bad guy. It makes their life easier if they think you know what you're doing and you're doing a good job. It may take some convincing. It may take a lot of education and explaining, but you just have to be patient and not, they mean well.
And use pictures.
And use pictures, right?
Question over here?
Yeah, do you find using like traditional banking examples as a way to help kind of bridge the knowledge gap? Like, I don't know, maybe in this case, just talking about book transfers amongst clients in a GL. You know, if you're just doing that within the system, even if you're breaking up, you know, the balances into,
you can see it. Yeah.
You know, like you can see it, you can track it all. I haven't had that experience yet to have to communicate, but I know for me, having some of those examples in traditional banking where you can kind of connect the dots has helped a little bit.
I think it really does. And I was at a conference a couple weeks ago, and head of financial crime for Coinbase was there, and somebody asked her about her compliance program, and she just said, it looks just like yours. Right? It executes a little differently sometimes, but it's going to look exact. It's got those pillars and the risk assessment and the oversight, right? It looks exactly the same. So I think using those, it's like a correspondent account where you can see every single transaction. It's not just coming from a bank in Bulgaria, right? You can see so those sorts of things I think can really help.
Yeah, and my go-to is just, you know, imagine you had the power to compel information from multiple counterparties in a series of transactions, right? Like, we have these typologies established in compliance, like wash trading or, you know, transfers where there's little change in value between 2 institutions and so on and so forth. And so, you know, I like to just say it's a red flag normally to have the deposit of one type of asset, the quick conversion to a bunch of other different things, and then, you know, watching it change form on the other side. Just imagine not having to do the work and issue all of those different subpoenas to those institutions, right?